Hello, once again, it's Steve. We're here to talk about the magic of life insurance with our chief wizard, Darren Hardison. Darren is the Gandalf of this journey. For those of you familiar with Lord of the Rings, this is Gandalf right here. This is the current version of him, specializing in life insurance magic. So every week he dazzles us, and we expect nothing less today. Hello,
No,
Darren.
no pressure. Let's go.
All right, so today's topic is my bank requires life insurance to finalize a business loan. How do I do that? So let's start with a question. Why would a bank do that?
Yeah, I mean the other description, I guess, is loan indemnification, right? So heaven forbid if something happens to you, banks are a business, they're for profit. They want to be sure they get paid back. So they don't want to be chasing down your heirs and your estate to pay the balance of an outstanding loan. So the premise of life insurance, or why they require it, is to be sure that they're satisfied if you were to die before the terms of the loan are satisfied.
I get that. And I know it's very common practice. I'm going to give you a question from left field. And I
Right.
acknowledge it may not be within your expertise, but is that really true? I mean, if I owe a bank $500,000 and God forbid I die, are they legally allowed to come after my wife or my estate?
Yeah. And again, I'll disclaimer, I'm not an attorney. But yeah, debt is not extinguished at death. So they would certainly try to put a lien on the estate. Um, it gets messy, and it takes time, especially if if an estate doesn't have clearly named beneficiaries, or if there is a will. You've always heard about probate. When an estate goes to probate, we joke and say the only people that make money are the attorneys in those instances. It takes forever. I'm in the state of Florida. I know a probate case in Florida takes well over a year. So just again, so the premise from an insurance company's standpoint, or excuse me, a bank standpoint, um, or any lender for that matter, is we don't want to have to go through all that. Let's make a clean, tidy little arrangement where if something happens, we know we'll get paid the interest, in the loan that we're owed.
Makes sense. Okay. So let's walk through the process. So I'm running a business. I apply for a $500,000 loan. The bank says, okay, we'll give it to you, but you got to get life insurance. So then what do I do?
Yeah, and one thing I wanted to comment on, and I know a lot of people watching will probably acknowledge this, in those circumstances, or even if there's not a loan, a lot of times we'll get a nice little letter in the mail from Wells Fargo or whomever, offering you life insurance, at great rates with, easy underwriting or what have you. And as you know, Steve, we always remind people banks are not insurance companies. They will have some sort of negotiated agreement with another insurance company to be on their platform. I've seen them in the mail myself. It's like you're reading it, you think it's from the bank. The bank's going to insure me, but then you see down at the bottom, it'll say underwritten by AIG or Transamerica. But they do that as a convenience, and it's smart. We're proponents of life insurance. Any life insurance is better than no life insurance. Obviously, being brokers, we know we can do better for the client as far as efficiency, pricing, better choices, what have you.
Wait a minute. You're saying that if I use the bank's insurance company, I'm not getting sweetheart underwriting? I'm not
You're
getting a better deal?
you're not you're getting convenience. Again, we're not knocking it, but again, we represent the clients. We don't represent the bank or anybody else. We work for the clients to be sure they have the best solution to whatever their planning issue is.
So the bank has a cozy agreement with an insurance company, which may or may not be the most competitive for me. Certainly would not be the most competitive for every one of the bank's clients. So okay, so I got to shop it out, and I contact Steve and Darren,
Yeah.
and but I'm feeling a certain amount of pressure because I got to get this money soon, and the bank won't close on my loan until I get a policy. So how does the time frame for getting the loan approval affect how you would react and help the client?
Yeah, good question, and it really depends on the circumstances. Hopefully we meet the client, we're introduced early enough into the process. Hopefully the bank communicates that early in the process versus, just tries to slide it in last minute. Oh, by the way, you need this insurance protection, and by the way, we have one right here. Very smart. Now, there are situations where, the client fortunately met us, understands that's not really a good deal. But there's a timing issue. I've seen this in some small business loans, SBA loans, where, they're crunching you for time. Well, we have access to other types of insurance, which are gap insurance, meaning they'll insure you for the loan indemnification until we can get you traditional. And we don't like to do that. It's a lot of work for us, but we'll certainly do that for clients to make it seamless and to be sure that they're protected, and most importantly, be sure they get the money that they need for whatever project it is they're doing.
That's a very good solution. That is definitely an example of the magic of life insurance. There's actually a temporary product that could be issued to satisfy the bank until the brokers work their additional magic and come up with a better price, longer term policy. Okay. So now let's go down the process a little bit. Um, what is your experience? Does the bank need to have a policy in force to approve the loan, or are they typically satisfied sometimes with just underwriting taking place and being given updates?
Yeah, and it really depends on really the people that you're working with inside the bank and the relationship the client has with the bank officer. I've seen like in smaller banks where they know the people. A lot of times, they'll just say, meet Darren. He's my insurance advisor. He's working on this, and I just copy him on the status of underwriting as time goes on, and that appeases them. Now, some bigger banks, they want to see an actual insurance policy issued, naming them as a beneficiary, not just naming them. Oftentimes, they actually require what they call a collateral assignment agreement in place, which I think we've talked about in an earlier episode, meaning it specifically they're first in line for whatever they're owed. If it's $1 million policy and the bank 6 years from now is still owed 500,000, this collateral assignment agreement assures them that they're getting their 500,000.
Well, what would happen if no collateral assignment was executed? What would happen if the bank was just simply named the beneficiary? Wouldn't that be easier?
It would be, but then if they're named 100% beneficiary, then they would get 100% of the policy. So if it was $1 million policy, the bank gets $1 million. Well, they're only owed 500 if the insured passed away in 5 years and they had paid back, half of the loan already. Obviously, that's not what the client wants, and I don't think that's really what the bank wants. But that's because of how it's set up. That's the power of having an advisor that knows how to set it up correctly.
Yeah, I'm sure there have been blunders, and I'm sure banks have been
Yeah.
given more than they deserve, and hopefully they return the balance. All right, let's take another step along the way since we're talking about assignments. Now, let's suppose that the insured, it was $1 million policy to indemnify a loan. We're 10 years down the road, and the insured has paid off the loan. Um, what happens to the policy?
Again, it's the insured, it's our client's policy. They own it. They're paying for it. What happens is once the loan is satisfied, now the client has to initiate this, and I usually, help as a communicator. The bank will release the collateral assignment. So there's a collateral assignment form, and then the insurance company has a separate form, which is a release of a collateral assignment. So the bank signs off and says, we're no longer, a beneficiary in the policy.
Okay, let's get technical for a second. Let's suppose that the insured has indeed paid off the loan, and however, somebody drops the ball and they forget to get that release. Can the bank still get any money from the benefit when it's paid? Do you know?
I think it's not as clean. I still think they're okay. Because when push comes to shove, they'll see that there's zero balance outstanding. Again, it's doing it the right way to be sure there's no hiccups. Maybe it would just take longer for the primary beneficiary to receive the death benefit. Maybe the insurance company would have to do further investigation. I think it would just be a delay. I think the end result would be fine.
Yeah, I
And
get that.
real quick, we talk to so many people, and people think insurance companies are evil and these big bad entities, and in my experience, they're not. They really try to do the right thing. My experience with claims, death claims, and you and I are getting older. Unfortunately, we've seen a number of clients that have passed away. So we've been through the death claim process and helping a grieving family and helping them, deal with paperwork, and at a time where, they don't really want to deal with it. Companies really try to get the check into the hands of the beneficiaries very quickly. I knock on wood, I haven't seen any, inordinate delays, at least in the past, from what I can remember.
No, I agree with that. And I'll just share along those lines. I had a client a number of years ago who had heart attack after heart attack after heart attack. He was a young guy in his 40s, and he would periodically say, "Give me another policy, give me another policy, give me another policy, give me another policy." And he paid for it. He paid a lot of money for a bunch of insurance, but to his credit, he knew the big one was coming. He just knew. And he had a massive heart attack, and he died on the operating table. He was like 43 years old. I remember this. And I had pre-qualified him, and I had gone through full disclosure of his entire heart history, on and on and on. And the company took maybe an extra day to pay that claim, but everything had been fully disclosed. They had all the information. Yep, this was a kosher claim, and we knew what we were getting into. Here's your money. So to address your point, something
Mhm.
like that, you'd think, wow, such a hard history. They must really want to put the beneficiary through the ringer. Nope, they wanted to pay that claim, and pre-qualification had given them all the information they need,
Mhm.
and it was 1 day delay. So to prove
I
your
think,
point,
I
that's what
think, yeah,
happens.
I think that's a great story. I think the life insurance companies somewhat fall victim to being affiliated with the property and casualty companies, the homeowner
Right.
companies. Living here in South Florida, hurricanes and storms and all these catastrophic things, and a lot of people have a really hard time dealing with the insurance companies. Hopefully they have a good agent who can advocate and help them navigate the process. But on the homeowner side, the property side, yeah, insurance companies can be a bit of a jerk sometimes. And I get it. I mean, it's huge claims, and a lot of them, frankly, decided not to do business in the state just because there was too much exposure. But the life insurance side is different. They're generally good guys.
They are, and you're exactly right. Life insurance companies get lumped in with the whole industry, and a life insurance claim is pretty cut and dry. You're dead. And there's and with P&C claims, there's all kinds of gray. What caused this? What caused that? But I get it. That's a very good point. All
Yeah.
right, so we took a little tour here also of claims in general, life insurance companies in general. Getting back to using life insurance to indemnify a business loan, are there any last points that you should raise to give people a well-rounded picture of this?
I guess, the biggest point we want folks to take away, whoever's watching live or maybe watching a taped version of this, is just, have a bell go off and say, well, uh, even if I'm not being required to maintain insurance, it's probably a really good idea. It's just one less thing for my beneficiary, my estate, to have to navigate if something happens and I pass. I know with certainty that source of cash liquidity is coming in. They can pay off the loan, they can pay off a portion, they can keep paying the loan. It just gives them more flexibility and more options. And another point is, I think we were going down this road and we didn't touch on it. What happens if you're uninsurable? What happens if a client's uninsurable, and we can't get a traditional policy? Then back to my point, there is specialty insurance out there specifically designed for individuals that have challenges. Now there may be exclusions or there may be circumstances, but those policies still satisfy the lending institution. So I know for a fact we've had a number of those where saved their bacon, so to speak, where the loan wasn't going to happen, and we're able to find this specialty program through Lloyd's of London or whomever we used. So the big thing is just ask. You might not think it's possible. You might not know what to do, and there's just so many solutions out there for people. Like any savvy consumer, don't go with the first recommendation you get from the bank. Talk to a broker, hopefully us, and be sure you're vetting out all your possibilities.
Sound advice there, and I like that part
Yeah.
about, hey, why not leave $500,000 to your spouse and children as opposed to having going to the bank? Use life insurance to pay the bank and
Yeah.
keep your IRAs and your investments and everything else intact for your heirs. That's
Yeah, and
good
I think
planning.
we talked about it briefly in another previous episode. We were talking about maybe mortgage insurance or
Right.
using life insurance to pay off a mortgage, or at least earmark some cash, if you will, to pay down a mortgage, to continue paying the mortgage. When one spouse passes and that income stream is gone, oh well, the surviving spouse isn't going to have to sell the house, isn't going to have to sell investments possibly at a loss. The list goes on.
Very good. Thank you, Gandalf.
Yeah, good stuff.
Good stuff. And thanks everybody for joining us, and we will see you next month.